Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Alex.
And I'm Jamie.
And this week, well, it feels like everything is moving at once.
It really does. Westminster is playing political musical chairs. You've got Nadhim Zahawi and Robert Jenrick defecting to reform UK. Starmer's U-turned on digital ID.
And the only thing flipping faster than the MPs seems to be Barclays' share price after that Trump proposal.
Exactly. The one for a 10% credit card rate cap. We're absolutely going to unpack that bombshell.
And we'll explore why former Revolut employees are facing these huge 47% tax bills while VCs are pocketing $2 billion.
And explain why getting healthy with Wegovy might, bizarrely, cost you £20,000 in mortgage capacity.
Plus, McKinsey's AI workforce is now a reality. They just revealed they employ 25,000 AI agents.
And on top of all that, global central bankers have staged what looks like an unprecedented mutiny to defend Jerome Powell. It really is a week where stability feels like a 20th century concept.
It absolutely does. The theme is unintended consequences, isn't it? And just this total collapse of boundaries between politics, tech, and finance.
100%. So let's start in our own backyard with the regulators. The PRA has just set out its 2026 supervisory priorities.
That's right. In those letters from Rebecca Jackson and Allison Scott, and also Gherkin and Wallace, both dated the 15th of January.
So what's the single biggest theme they want firms to get a grip on this year?
The focus is clearly on strengthening resilience. And the clearest mandate is this real intensification of scrutiny on counterparty credit risk, CCR.
Right. Specifically linked to the non-bank financial institutions, the NBFIs.
Exactly. We hear about NBFIs all the time, but the PRA letters gave us a really sharp data point on the scale of the exposure.
They did, didn't they?
According to the Bank of England's own analysis, major UK banks have trading book exposures to NBFIs of around £120 billion.
120 billion. Wow.
And the PRA's big concern, as they put it, is that these complex interconnections, especially with private equity, are, and I'm quoting, not yet tested by a severe downturn.
That's the scary part. It's a blind spot. So if the risk isn't tested, what do they actually want to see from compliance and risk teams?
Well, it comes down to data, robust, granular data, which brings us to their second priority, fixing what they call persistent weaknesses in data quality.
So it's all about the Pillar 2 data rebasing exercise.
That's the one. Firms have to provide timely, high-quality data for submission by the 31st of March 2026. If you can't accurately report your slice of that 120 billion pound NBFI pie, the whole system starts to look brittle.
So a hard deadline and more scrutiny. That sounds like a lot of heavy lifting. But the letters did include a genuine win for the sector, didn't they?
They did, yes. A significant bit of regulatory relief, actually. They plan to transition all remaining firms to a 2-year periodic summary meeting cycle.
The PSM cycle.
Yeah.
So moving away from mandatory annual meetings.
For many institutions, yes. It's a major reduction in the regulatory burden. And the idea is you reinvest that freed up time directly into fixing those data quality issues or, stress testing that NBFI exposure.
A very sensible trade-off. Give banks back time so they can focus on the big risks.
Precisely.
Okay. So let's pivot from prudent British regulation to the sheer political volatility across the Atlantic.
Yes. We saw immediate and frankly dramatic regulatory contagion this week. Proof that U.S. political risk is now a core part of UK banking valuations.
You're talking about Donald Trump's credit card rate cap proposal. What exactly was the policy bombshell?
It's incredibly simple, which is why it's so potent.
Oh.
A 1-year 10% cap on U.S. credit card interest rate.
10%, when the current average is over 20.
Exactly. He announced it on Truth Social, saying they would, quote, no longer let the American public be ripped off.
And the immediate casualty in London was Barclays.
Oh, absolutely. Their shares tumbled by 5% on the day. The worst performer on the FTSE 100.
And that's because they're such a huge player in the U.S. card market.
A massive player. They generated something like £3.3 billion from that arm in 2024 alone. Any threat to U.S. unsecured lending hits them directly.
It sounds great for indebted consumers, but wouldn't a cap that low just kill credit access for the very people it's supposed to help?
Well, that's what analysts are warning. It would just upend the economics of the industry. Banks would have to tighten underwriting dramatically.
So cutting limits, closing riskier accounts.
Right, and getting rid of rewards programs. Bill Ackman, the billionaire investor, called it a mistake in a tweet he then deleted, arguing it would harm high-risk borrowers most.
So the policy ends up hurting those who need credit most. And the real question for you, our listener, is whether this idea could gain traction here in Westminster, given the UK's own cost of living crisis.
It's a very real risk.
Now let's talk about another financial contradiction. A massive investor windfall versus a debilitating tax trap for staff, all at Revolut.
This is such a painful illustration of how technical errors can just swallow good intentions. I mean, on one side, Balderton Capital exited about $2 billion of its stake in 2025. A huge win.
Capitalizing on that $75 billion valuation. But the sting for the employees?
A very harsh reality. They're being hit with tax rates of up to 47%. That's income tax plus national insurance.
Instead of the 24% capital gains tax they were expecting. That basically doubles their bill. How does that even happen with a tax advantage scheme?
It all comes down to a disqualifying event, according to HMRC's strict rules. The scheme, a CSOP, only works if you stick to the original terms.
And Revolut changed them.
Well, they told staff their post-leaver exercise window had been extended to 10 years, which sounds great. But HMRC treats that variation as a disqualifying event, so the gains are no longer capital gains.
They become employment income.
Exactly. Taxable at the highest rates.
Yeah.
The lesson here for any UK firm using equity schemes is that internal HR guidance, or FAQs, they just don't override tax law.
If you're finding this useful, don't forget to subscribe to RegTalkUK on YouTube or follow us on Spotify. It really helps us reach more banking professionals like you. Now, back to the briefing.
Okay, switching focus now. From administrative risk to a huge systemic liquidity threat. Bank of America's CEO, Brian Moynihan, issued a really striking warning this week.
About stablecoins and the potential for massive financial disintermediation.
Yes, that's the classic threat, where tech removes the middleman, in this case, the bank. He put a number on it.
What was the number?
He warned that if U.S. law allows stablecoins to pay interest or rewards, up to $6 trillion in customer deposits could migrate out of traditional banks.
$6 trillion. That's, what, a third of all U.S. commercial bank deposits?
Between 30 and 35%, yes. It's a systemic drain on bank funding.
So what does that mean in practice? If you lose that cheap deposit base, what happens to the cost of lending?
It goes up dramatically. Banks are forced to rely on more expensive wholesale funding. Credit tightens, and it gets harder for SMEs in particular to get the loans they need to grow.
And what's interesting is how the Bank of England is trying to get ahead of this exact risk here.
They are. Their proposed systemic stablecoin regime from that paper in November 2025 has very strict rules on backing assets, requiring high-quality liquid assets, or HQLA.
Which is specifically designed to stop stablecoins from becoming interest-bearing deposit substitutes.
Precisely. It's a textbook example of regulation trying to anticipate a crisis, not just react to one.
Okay, from systemic risk to the future of the workforce. Or maybe the hybrid workforce.
Yeah.
McKinsey just gave us a mind-blowing metric on this.
It's a landmark announcement, really. The CEO, Bob Sternfels, confirmed McKinsey now has 65,000 workers.
But that's the key word, isn't it? Workers, not employees.
Exactly. Only 40,000 of them are human. The other 25,000 are AI agents, autonomous virtual assistants.
So AI agents are already more than a third of their workforce?
Mm-hmm.
And they have an aggressive target.
A 1-to-1 ratio of humans to agents within 18 months. He said the agents handle the search, crunch, and draft work, saving millions of hours.
So for UK banks, which rely so heavily on these consultancies, how does this change third-party risk management?
It creates a whole new level of complexity. You need robust governance to check if the analysis you're getting is human-generated or AI-generated, and you need to be sure it's explainable and compliant.
We've talked a lot about tech and systemic risk, but let's look at maybe the most striking social consequence of the week, the Wegovy Mortgage Penalty.
This story, first reported in The Guardian, is just such a paradox. We know these new weight loss drugs like Wegovy and Mounjaro are incredibly popular.
And expensive. A private prescription is, what, 200 to 350 pounds a month?
That's right. And the consequence for mortgage applicants is that lenders are now classifying this cost as committed debt, like a loan, not discretionary spending.
So it directly reduces their affordability.
Significantly. Brokers estimate a £250 monthly payment can knock up to £20,000 off the maximum mortgage loan offered to a first-time buyer.
So you have this incredible irony. A medical decision to improve your long-term health is financially penalizing you in the housing market.
It perfectly captures that collapse of boundaries we're seeing everywhere in 2026.
Right. And finally, let's wrap up with a rare moment of global technocratic solidarity. the defense of Jerome Powell.
This was genuinely historic, following that Department of Justice probe into the Fed chair, which many saw as politically motivated.
You had 11 global central bank chiefs issue a joint statement of full solidarity.
Unprecedented. And crucially, this included the Bank of England's Andrew Bailey and the ECB's Christine Lagarde.
Right. The statement warned that central bank independence is the cornerstone of stability.
And Janet Yellen's quote was incredibly strong. She called the investigation extremely chilling and a step towards a banana republic model.
Why does this U.S. political fight matter so much to London and Frankfurt?
Because the Fed's independence is crucial for global financial confidence. Any hint it could be politically compromised would destabilize sovereign debt markets everywhere. It was a clear signal that an attack on one is an attack on the whole system.
Which brings us to our quick hits, the essential, fast-moving changes you need on your radar right now.
Okay, starting with enforcement. CaixaBank received a significant fine, somewhere between 17 and 30 million euros, for serious AML failures linked to that controversial Cepsa tower sale.
A legacy issue from Bankia. And on the fraud front, the SFO arrested 6 people in the £300 million probe into Home REIT.
On operational resilience, a big step forward. The UK authorities, the BOE, PRA, and FCA, signed a memorandum of understanding with the European supervisory authorities to coordinate oversight of critical third parties.
That's a crucial link between the UK CTP regime and the EU's DORA framework.
It is. Moving to markets, the FCA cracked down on complex ETPs, noting 82% of retail trades were held too long. But they did lift the ban on certain crypto ETNs, though they're still restricted.
And some good news from the macroeconomic data. UK GDP grew by 0.3% in November.
That was driven mostly by the rebound in car manufacturing after the JLR cyber recovery, and 10-year gilt yields have fallen to around 4.34%.
In big tech, Elon Musk's XAI is under investigation by Ofcom and others for deepfake image generation by its Grok chatbot.
While separately, Apple selected Google's Gemini models to power the next generation of Siri, a huge win for Google.
And finally, your market outlook. Citigroup analysts are forecasting gold could potentially hit $5,000 an ounce by March 2026.
All this happening as Nadim Zahawi and Robert Jenrick defected to Reform UK. A busy week.
Let's try and recap the essentials then. The PRA wants better MBFI data, but is giving you those 2-year PSM cycles in return.
Trump's rate cap is actively repricing transatlantic risk for UK banks.
Revolut's tax trap is a huge warning for every single equity scheme out there.
Stablecoins could potentially drain $6 trillion from banks if they become interest-bearing.
McKinsey is going synthetic. Wegovy is, believe it or not, a mortgage killer.
And central bankers just defended Jerome Powell in a way we've never seen before.
For compliance, risk, and legal teams, I think the message is pretty clear. 2026 is the year of adaptation, not prediction.
That's all from us this week. Thanks for listening to RegTalkUK.
Until next time, stay sharp and stay compliant.